401k after a layoff. A layoff changes more than a job title. It disrupts schedules, routines, stability, and often identity. But there is one financial consequence most people overlook in the middle of the chaos. It is the orphaned 401k, sitting quietly inside an old employer's system, waiting for someone to make a decision. For many workers, that account is one of the largest assets they own, yet in the weeks after a job loss, it becomes invisible. Today's episode breaks down what really happens to your 401k when a layoff hits, what traps most people fall into, and how to protect your long-term financial future even while navigating unemployment. Recent data shows that layoffs have surged dramatically. October job cuts jumped by more than 175% compared to last year. Major corporations across retail, logistics, technology, and healthcare have all trimmed staff, and many companies are quietly restructuring teams to rely more on automation and AI. This kind of disruption creates emotional stress, but it also creates financial urgency. In this kind of environment, retirement accounts cannot be an afterthought. They need to be part of your survival strategy. The first detail most people forget is that their 401k is not frozen in time after a layoff. Depending on the rules of the plan, you may have deadlines, loan obligations, tax exposure, or rollover opportunities that must be handled quickly. One of the biggest risks appears when someone has an outstanding 401k loan. Roughly 13% of workers borrow against their accounts, and the average balance is around $11,000. If a layoff happens, that loan doesn't disappear. In fact, in many plans, it becomes due immediately. If you cannot repay the amount within the deadline set by the plan, the loan may be treated as a distribution. Once that happens, you'll owe income taxes on the amount. If you are younger than 59 and a half, you may also face a 10% early withdrawal penalty. For someone already navigating unemployment, this becomes a painful and unexpected hit. However, not all plans follow the same rules. Some allow terminated employees to keep repaying the loan even after they leave the company. Others allow the loan to be rolled into a new employer's plan. A growing number of large companies, particularly those with more than 5,000 employees, accept rollovers that include outstanding loans. The key is to check the specific rules of your plan before you do anything else. Understanding your loan options can be the difference between a temporary setback and a permanent financial loss. After addressing loan obligations, the next major decision involves the balance of your 401k. You have several paths, and each one has its own advantages and hidden risks. The simplest choice is leaving the money in your former employer's plan. Most companies allow this if your balance is above a certain threshold. If the balance is below $1,000, the plan may automatically cash it out and send you a check. This check counts as taxable income, and if you're under 59 and a half, it will likely trigger the early withdrawal penalty. If your balance is under $7,000, your employer may automatically roll it into an IRA you didn't select. These default IRAs often invest the money in cash or low-interest funds, slowing down your long-term growth without you even realizing it. Another option is rolling your money into your new employer's plan. This can be beneficial if the new plan offers strong investment choices, low fees, or the ability to consolidate your retirement accounts into one place. Consolidation helps many people stay organized and avoid losing track of accounts over the years. It may also maintain the protection and structure of a 401k environment. But not all plans are equal, and some employer plans have higher fees or fewer options than an IRA. The details matter, and comparing your plans side by side can help avoid regret later. A third option is rolling your 401k into a traditional or Roth IRA. A traditional IRA rollover is straightforward and avoids immediate tax consequences. A Roth IRA rollover, however, triggers taxes because you're converting pre-tax dollars into after-tax dollars. For someone who recently lost their job and expects their income to be lower for the year, a partial Roth conversion might actually be beneficial. You pay taxes now at a lower rate, and the money grows tax-free in the future. But this is a decision that should be made carefully. A poorly timed conversion can create an unnecessary tax bill during an already stressful time. Regardless of the option you choose, one rule should be followed almost every time. Use a direct, trustee-to-trustee rollover. This means your old plan sends the money directly to your new plan or IRA custodian. Avoid having the check issued to you personally. When the check is written in your name, the IRS may treat the amount as a distribution if you don't redeposit it correctly and on time. Even a small clerical mistake can lead to taxes and penalties. A direct rollover removes this risk entirely. Another factor many people overlook is vesting. Not all employer contributions automatically belong to you. Vesting schedules can take anywhere from 0 to 6 years. If you are not fully vested when you leave your job, you may lose unvested matching contributions. This can be frustrating, but it's important to know where you stand. Many workers assume that employer money in their account is fully theirs, only to realize later that part of the balance disappears after separation. While dealing with all of this, it's easy to feel overwhelmed, but the key idea is simple. A layoff is temporary. Your 401k is long-term. The decisions you make in the weeks after losing a job may influence the next 20 or 30 years of your financial life. Taking time to review your account, study your plan's rules, compare rollover options, and understand tax implications can save you significant money and stress in the future. In a world where layoffs are becoming more common and less predictable, every worker needs a plan for managing their retirement accounts through transitions. Whether you are navigating unemployment today or preparing for the possibility in the future, understanding your 401k options empowers you to protect your wealth. The goal is not just to survive the layoff, but to secure your long-term financial independence. A forgotten 401k is more than an account in an old company system. It is a foundation of your future stability. Treat it with the urgency and respect it deserves.